This video will explore 7 compelling alternatives to venture capital that can help you raise funds while keeping more control over your company. We'll examine the advantages and disadvantages of each option and provide a comprehensive guide to navigating early-stage funding. Below, we will look at 7 alternatives to venture capital funding that you can start exploring today. Make sure to watch the whole video to the end. 1. Startup accelerators and incubators. Startup accelerators and incubators are organizations designed to support fledgling businesses by providing funding, mentorship, and resources in exchange for equity. They serve as breeding grounds for innovative ideas, helping early-stage startups transition from the concept phase to a viable business model. Accelerators, such as Y Combinator and Techstars, typically run for a fixed period, during which startups receive intensive support to rapidly scale their operations. Incubators, on the other hand, offer a more flexible long-term approach, often focusing on nurturing startups in their very early stages. Some of the advantages of startup accelerators and incubators include mentorship and expertise, access to resources, and increased visibility. While disadvantages of startup accelerator and incubators range from equity trade-off and fixed time frames. 2. Angel investors. Angel investors are affluent individuals who provide capital to startups in exchange for equity or convertible debt. They are one of the alternatives to venture capital funding. They often invest in the early stages of a company, providing the critical funding needed to get a startup off the ground. Angels typically have a high tolerance for risk and are more willing to invest in unproven business models compared to venture capitalists. 3. Investment syndicates. Investment syndicates are groups of angel investors who pool their resources to make larger investments in startups. They are one of the alternatives to venture capital funding. A syndicate is typically led by a well-respected angel investor who sources deals and presents them to the group. This collective approach allows startups to secure more significant amounts of funding from a single source while benefiting from the collective expertise of the syndicate members. Advantages of syndicate investment includes access to multiple investors, expertise, and strong network. While the disadvantages of syndicate investment can range from longer decision-making process to complex legal structures. 4. Funding from family and friends. Raising capital from family and friends is one of the most common ways to fund a startup in its earliest stages. This approach involves seeking investment from people you know personally, who are willing to support your venture based on their trust in you rather than the business itself. 5. Crowdfunding. Crowdfunding involves raising small amounts of money from a large number of people, typically through an online platform. It is one of the alternatives to venture capital funding. Crowdfunding allows startups to tap into the collective financial resources of a broad audience, often in exchange for rewards, equity, or early access to products. 6. Revenue-based financing. Revenue-based financing, RBF, is a funding model in which investors provide capital in exchange for a percentage of your future revenue. Unlike traditional loans, RBF payments fluctuate based on your business's revenue, offering greater flexibility during periods of lower income. Some of the advantages of revenue-based financing include non-dilutive funding, flexible repayment terms, and faster access to capital. While the disadvantages of revenue-based financing are higher cost of capital, revenue dependency, and limited to revenue-generating businesses. 7. Strategic partnerships. Strategic partnerships involve collaborating with another company or organization that provides funding, resources, or expertise in exchange for a share of your future profits or equity. These partnerships are often formed with companies that have a vested interest in your startup's success, such as suppliers, distributors, or industry leaders. The advantages of strategic partnerships are access to resources and expertise, shared risk, and increased credibility. The disadvantages of strategic partnerships are loss of control, complex negotiations, and obviously potential conflicts of interest. In conclusion, while venture capital is a well-known and widely used method of funding startups, it is by no means the only option. Exploring these 7 alternatives to venture capital funding can provide your startup with the resources needed to grow while allowing you to maintain greater control over your company. Each funding option has its unique advantages and disadvantages, so it's essential to carefully consider which approach aligns best with your startup's goals, stage of development, and industry. Thank you for watching this video. If you enjoyed or learned something, please show love by subscribing, liking and sharing this video before you leave.